Next question. Consider following information. Amount of interest is 1,20,000. Amount of depreciation is 80,000. Repaid principal during the year 2 lakhs. Income tax rate is 40%. Earning after taxes is 5 lakhs. This is the basic information given. There are two questions. First is calculation of interest coverage ratio, and the second is the calculation of debt service coverage ratio. I request you to go through the question. Please calculate interest coverage ratio and put your answer in the chat box. Let us see how to make the calculation of interest coverage ratio. First of all, I am giving some simple values to give you explanation. Suppose a company has operating income of 5 lakhs and the company has to make payment of interest of, let us say, 1 lakh. Then interest coverage ratio is found as 5 lakh upon 1 lakh. That comes to 5 times. What does this 5 times is indicating? This 5 times is indicating that, say, for every 1 rupee of the interest to be paid, you have the funds arrangement of rupee 5. That is what the interest coverage ratio is indicating. What is the amount of the operating income that you have for every 1 rupee of the interest to be paid is interest coverage ratio. Okay. Now, in this question, what must be the interest coverage ratio that we are required to find? The question is providing the interest amount directly. There is no doubt about it, 1,20,000. Now basically we are required to make the arrangement of the numerator, that is EBIT. As far as the EBIT is concerned, so working note number 1, calculation of EBIT. It is calculated as earning before taxes plus interest. That is the way the EBIT is found. As far as the earning before taxes is concerned, it can be calculated as earning after taxes divided by 1 minus tax rate. That is the way the EBT can be found plus interest. Earning after taxes is an amount of 5 lakhs into 1 minus 0.4. So that is the way you compute the EBT. To that, interest of 1,20,000 is added. So over here, 5 lakhs upon 0.6, that comes to 8,33,333 plus 1,20,000. So the total is 9,53,333. This is the way the operating income is found. Once you calculate the operating income, afterwards you are required to compute the interest coverage ratio. So ICR, interest coverage ratio, is operating income, EBIT, upon interest. So 9,53,333 divided by 1,20,000. So 9,53,333 upon 1,20,000. So the answer is 7.94 times. I request all of you to take down answer of EBIT and based on that, interest coverage ratio. Head on further. ICR, interest coverage ratio, is indicating that what amount of EBIT company has for every 1 rupee of interest to be paid. Read on further. This ratio is calculated from lender, in bracket write down, bank point of view. Full stop. Higher the ratio, comma, indicates sound financial position and vice versa. Full stop. Now friends, we are proceeding for the next ratio, that is called debt service coverage ratio. Let us have understanding that say what do we understand with the term debt service coverage ratio and how it is calculated. Dear students, you can very well understand, say when I compute the interest coverage ratio, then in that case, say we are focusing only on the interest payment. But definitely the lender would be interested that say whether the borrower is capable of making payment of not only the interest but also the principal. So DSCR, debt service, means so the bank wishes to know, lender wishes to know that whether the borrower is having so the adequate capacity to make payment of interest, to make payment of the principal. That is the way so the DSCR is calculated. Students are requested to pay attention. Debt service coverage ratio is, let me explain you, calculated as profit after taxes plus interest plus depreciation plus any other non-cash item if provided to us, divided by interest plus principal repayment due during the year. See, understand logically friends. This ratio will be calculated considering the numerator is the amount which is available for servicing the debt financing and denominator is indicating that what amount is required to be serviced. So in that say we will have the interest. The amount of the interest is 1,20,000. Amount of the principal is an amount of 2 lakhs. So what amount is supposed to be paid? We are required to make the payment of 3,20,000. In order to pay 3,20,000, what amount of the funds we have in the pocket? Earning after taxes is 5 lakhs. Plus amount of the interest is 1,20,000. Plus depreciation, that is 80,000. Depreciation is added to the numerator because depreciation is a non-cash item. It is not out of pocket cost. That is the reason so the depreciation is added. While calculating the profit, depreciation must have been deducted. So now depreciation is added. So it is 5 lakhs plus 80,580. And importantly, we add over here interest. Why interest is added? For that I give a small explanation. To give that explanation, I go back to the interest coverage ratio formula. I want you to write in the chat box, for interest coverage ratio, can we have a formula like this? EBT upon interest. Give your answer along with the reason. Friends, this formula is wrong. Why this formula is wrong? Because what happens that say when you take EBT in the numerator, it means that say the interest has already been paid. Once you already have paid interest, then what is the point in asking that what amount of the funds that we have for paying interest? That is the reason so this is wrong. It has to be EBIT upon interest. That is what we understand. Okay, so now you can see that's over here in the formula you have in the division amount of the interest. So basically you want to know that say what is the funds available for making payment of the interest and for the purpose of making repayment of the principal. So the numerator should be excluding interest. The numerator that we should derive should be excluding make, that is, it should be before making payment of interest. But since interest is an allowable expense from tax point of view, so in the numerator we take PAT. Listen carefully. Since the interest is an allowable expense from tax point of view, for the purpose of correct calculation of the income tax, interest has to be deducted. So the interest has already been deducted in calculation of this figure. But since interest is the part of the denominator, so in the numerator, interest is once again added back. Depreciation is added because it is a non-cash item. Interest is added. Why? Because interest is a part of the denominator. That is the reason, so in the numerator, interest is added. So over here, answer will be calculated 5 lakh plus 1 lakh 20,000 plus 80,000. That comes to 7 lakhs divided by 3 lakh 20,000. So the answer would be 2.1875. Write down new heading DSCR. In bracket write down debt service coverage ratio. In that write down first point ICR interest coverage ratio is indicating ability of the company to pay interest. Full stop. DSCR is indicating ability of the company to make payment of interest and principal. Third point, higher the ratio, comma, sound financial position, and vice versa. Now write down answer. DSCR PAT plus interest plus depreciation divided by interest plus principal due during the year. Friends, over here in the question, we have not been given that say what was the amount of the principal which was due. We have been given information that what amount of principal that we have repaid. We'll assume that say whatever was due itself is paid. Profit after taxes is 5 lakhs. Amount of the interest is 1,20,000. Amount of depreciation 80,000. Amount of the interest is again 120. Principal amount due during the year 2 lakhs. So that comes to 7 lakhs. Divided by 3,20,000. 7 lakh divided by 3,20,000. So we get the answer 2.1875. Please write an answer. Write on further a note. Depreciation is added to PAT because depreciation is a non-cash item. Full stop. Further write down in that interest is added because it is part of debt servicing. Full stop. Further in that write down interest is an allowable expense from tax point of view, comma, so it has to be deducted in computing PAT.